Hello friends, today we're going to be discussing what is a slow flip. So what is this crazy term, slow flip? What does it mean? So by the end of this video, you'll fully understand how slow flips can transform your investment strategies by allowing you to enhance property values over time. You'll also be able to capitalize on tax advantages and create a steady long-term income. This isn't just about quick gains, but more about building wealth over a period of time. Have you ever wondered how slow flips work or what that term means and how it compares to traditional flips? Throughout this video, I'm going to break down exactly how slow flips can be an incredible investment strategy by first explaining how slow flips vary and differ from traditional flips in real estate. And next, I'll outline exactly how slow flips work and finally how they can benefit you as an investor. If you're ready, let's go. How do slow flips differ from traditional flips in real estate? So stick with me here because once you understand how slow flips work, it's absolutely going to blow your mind. But first off, to understand this, let's take a look at the traditional flipping strategy in real estate. If we break it down to its core and its simplicity, flipping real estate is just this: someone who is buying a property at a discount and looking to turn around and flip or sell that property for a profit, or at least more than what they bought it for if they bought it here and sold it here. Let's take an example. Let's say that you're in whatever city you're living in right now, and you go find a piece of property. And let's say this property is maybe listed, or maybe it's for sale by owner, or maybe you just approached this person and said, would you be interested in selling your home? And you have a good understanding that the market is here, and you're thinking, if I can get them out at a price below market, then I'd be interested in making that purchase happen. So you go, you get under contract for a price below market value, right? And hopefully it's significantly below market value, but let's just say it's below market value. And you go in, you purchase that property, you're able to create a win-win situation for you and the seller, and then what you can do is go ahead and market that property and sell it for a higher price. I mean, as simple as that sounds, that's exactly what flipping real estate is. Now, there's a lot of strategies embedded in this, a lot of sub-strategies, but in essence, buying here, selling here, making that difference. Now, one really important element when it comes to flipping homes in real estate is this: you've got to negotiate on price. It does not work unless you get a property below market value at a really good price. When I've seen this over the years, when people have been able to execute and get a property below market value, there's usually two factors that come into play on getting a property at a low price. And those two things are this: either you're looking for a distressed seller or a distressed piece of property. Now let's dive into those terms really quick. So a distressed seller is one who is maybe in a challenging situation. Maybe they're going through a divorce. Maybe they need to move really quickly. Maybe they just can't make their payments. That is a distressed seller. And typically, if you find a distressed seller, they're willing to find situations where you can create a win-win for you and for them to solve their problem. And this is really important when you're doing flips in real estate or any deal in real estate, is you don't want it to be transactional, right? You don't want it to be like, hey, I'm really negotiating you down at a price that's really low because this is what I want it for. It's got to be, what is their problem and how can you bring a solution to the table to solve their problem? If they feel like you're solving their problem, the chances of them moving forward with you and executing on the sale of their property is going to be so much greater than if it is transactional. Now, the second part of this is a distressed property. When I say distressed property, hopefully we all know and understand that is a property that might not look how it should look. Maybe it's a little bit run down. Maybe it hasn't been maintained for a while. Maybe there's a lot of things that need to be fixed inside or outside that home, but that is a distressed property. And if you have a distressed property in a nice neighborhood, in a nice area, then chances are that's going to have to be sold at a much lower price because you, as the buyer or any buyer, realizes that they're going to have to put money into maintaining this property or getting it up to the level of other properties around it to be able to sell. So now that we understand how important price is when it comes to flipping any type of real estate, whether it's a slow flip or a fix and flip, now let's dive into the strategy of slow flipping. So a slow flip got its name in the fact that it isn't something that's turned around rather quickly. Traditional flipping in real estate, if you buy it, you're looking to turn around and sell it as quick as you can, because the more time it takes you to sell it from when you bought it is the more money you have to outlay in maybe mortgage payments, interest payments, or other maintenance has to be done on the property. So you're looking to flip it very quickly. A slow flip takes a little bit longer. Now, traditionally, when people have said slow flip or talked about slow flip, here's one element that people have thought about, even that people have done, and that is buying the property, actually moving in and living in the property and fixing it up over time, and then turning around and selling it. Now, for a lot of people, that is a slow flip. But let me tell you what I've seen when it comes to slow flips and just a little bit of a different spin on that. So the slow flip model that I've seen success with, and I've known a lot of people who've also seen success with this model, works like this. Same thing, you buy a property that is distressed or distressed seller, you create a win-win situation, you purchase that property and you get it at a low price. Now your goal is to turn around and sell that property to somebody, but instead of selling it to them outright, you're selling it to them as if you were the bank. Let's say you bought this piece of property and you turn around and sell it for a higher price, but rather than getting all the money up front on a traditional flip, you are selling it to this person where you are actually the bank and you're gonna finance this home for them. And that person is going to live in this home as a resident of that home. That will be their home. So how does this work exactly? So for example, if you're buying the home, let's go out and say that you find a property that's listed at say $75,000. Now, in order to execute on this strategy, you're gonna have to offer well below that, right? Out of maybe 15 to 20 properties, I might get one of those accepted in this strategy, because if it's listed at 70, 75, I'm offering around $50,000. So let's say that I put a price out there for $50,000 and they reply, maybe they meet me halfway at $60,000. Eventually we agree on $53,000 on that property. Now, the reason they might agree on that is because I am paying cash for that. Now, am I utilizing my own cash? I'm not. I found an investor who is willing to come in and loan me that money to purchase this home, and they're charging me a much higher interest rate than maybe a traditional bank loan would be, but I'm getting that money right away. Let's say maybe it's anywhere between 8 to 12, 13%. Now, I've been fortunate to find some investors that are only charging me between 9 and 10%, but I know most people are charging between 10 to 12%. Now, they give you that money, you buy the home, and you find somebody who wants to own and purchase a home, right? So they come in, and I've utilized realtors, I've utilized mortgage brokers who've maybe said, hey, I have somebody who wants to buy a home, but they just can't get a loan yet. So I become the solution for them at that point. I'm saying, listen, I'm willing to sell the home for them. Here's my price. I'm selling it at $75,000, $80,000, right? So instantly, I've got a gap from where I bought it from, what I'm turning around and selling it as. So to follow this example, I got it at 53. Let's say that I turned around and sold it at $80,000, right? There's a $27,000 gap in what I bought it for from what I'm selling it at. But here's the benefit to the person coming and buying it from me. I will finance it to them over a 30-year period of time at a little bit higher interest rate than they can get through a bank, but maybe they can't get a bank loan. That's why it works for me. And I might just charge them a little bit down. And sometimes I've done where there's no money down, right? But I get first and last month's rent and a deposit. Now, here's the interesting thing about slow flips is the money I've borrowed from my private money lender, I am looking to pay that off within 5 to 8 years. And yes, I'm financing it to the other person over a 30-year mortgage. And the overall goal is to have the payment coming from the person purchasing the home from me to be able to make the payment and pay the money that's required by the private money lender to get that paid off within 5 to 8 years. So if my loan's at $53,000, let's say my little bit higher interest rate, my payment is about $850. And let's say financing it for this individual at $80,000, it may be 8.5 or 9% is going to be maybe say $950, right? I always have two mortgage calculators pulled up on my computer so I can make sure that I'm getting the numbers correctly, because I definitely want this person's payment to me to pay for the loan to be paid off in 5 to 8 years. And the closer I can get that to 5 years, the better off I'm going to be, right? Because the goal is this isn't a strategy where you're going to make a ton of money right off the bat, but when that 60th month or that 72 month or 84th month happens after 5, 6, 7 years, everything after that, that 950 coming in is coming in for the remainder of that 30-year mortgage. And if you have multiple properties like this is a great strategy to build some amazing wealth in real estate. And you know what? I learned this strategy not too long ago. It's something that you can jump into right now in this economy. A good friend of mine, Antonio Edwards, is somebody who's kind of a pioneer in this industry. If you get a chance, go look him up. He's absolutely amazing. But he is somebody who really walked me through this strategy and helped me fully understand it. And one other important element when it comes to slow flip is when I sell this property to somebody, I'm not using a traditional purchase and sales agreement, but rather I'm using a land contract. And let me explain why I'm doing that. Now with a land contract, the buyer takes possession of the property and pays the seller in installments over a period of time. The buyer is responsible for everything, the property taxes, the insurance, the maintenance, the repairs, just as if they were the homeowner, which they are, but it's not fully executed until that final payment is paid. And so they've got a land contract which states they're the homeowner, but it's not fully executed until that loan is paid off and that land and deed is then executed. And here's another thing, is the nice thing about a land contract, the reason I do that versus a typical purchase and sales agreement, is the fact that I can treat them like a tenant. So as a landlord, if they do not make payments, rather than foreclosing, which is a tedious, just horrible process, I can evict them as if they were a tenant, but I have none of the landlord responsibilities. So with this strategy, it is something that is absolutely beneficial in today's market with interest rates as high as they are. The whole goal behind this, somebody explained this to me and it makes a lot of sense. You're buying the home as if it were a car, right? You think about an auto loan, you're paying that auto loan off in hopefully 4, 5, 6, 7 years, depending on how much the auto loan is, but you're selling it as a home. So buying the home as if it were a car, selling it as if it were a house, right? And if you have that strategy in mind, this is something that will set you up for long-term great wealth over a period of time, and something that just continues to grow, because this is something that's kind of a rinse and repeat process, right? If you've bought one, you can buy another and another. I know a gentleman that I watched on one of Antonio's videos that has 170 of these properties, and a lot of them are coming up on that 60th month. So if he has 100 of those and his mortgage payment is say $900 on average on those, 100 times 900, that gentleman's gonna be making $90,000 a month on this strategy after that short-term loan is paid off. Now, this is a strategy that I'm getting really excited about, that I've started to engage in right now, but I'd be interested if you've ever heard of a slow flip, or if you have questions about it, please comment. Let's engage in a dialogue. And as always, just for stopping by, I've got a free gift for you. It is my short-term rental calculator, where you input the numbers, the income, the expenses, the purchase price of a short-term rental, and this calculator will spit out to you whether it's a good deal or not. Just click on the link below. It's aaronsfreetraining.com. And once again, thanks for stopping by. Have an amazing day.